What is it? That's the only central bank that still has a net short position in derivatives. It is clear in the COMEX futures market, where we can connect the monthly payments made by the Fed back to the BIS. We have seen this every time the Fed had to buy back their short-sold lease borrowings, resulting in a series of rising prices. Now it's the bigger, unallocated short bets that are made without having the actual stocks on hand. The gold market is reaching one of its most important moments in recent history. There is growing evidence that the Federal Reserve is in a tough spot due to large short gold derivative positions, which is making it buy back leased gold at higher and higher prices. This exposure, which can be seen through COMEX records and BIS payment trails, shows that the Fed could be at risk during a global change in the value of gold. As Basel III changes the market and demand from China increases, the old paper-based price control system is failing. Global liquidity has moved to physical exchanges, like the Shanghai Gold Exchange, where real price setting is happening, free from Western influence. Andrew Maguire, an experienced analyst of precious metals and whistleblower, has spent many years revealing manipulation in the gold market. He explains how this situation might lead to a formal U.S. response. Revaluación del oro de la tesorería. He believes that as the COMEX starts to follow prices instead of setting them, the use of synthetic paper to keep prices down will not last much longer. The difference between physical gold and paper gold has become too large to keep going like this. Esto significa que el precio real del oro podría ser ajustado dramáticamente al alza pronto. Now we share the clips from Andrew Maguire's interview. Before we keep talking about this, please subscribe to our channel and turn on the bell icon for quick updates. Gracias y disfruta del video. We will look closely at how this puts the Fed at risk of a forced gold revaluation. We'll do that soon, but first, let's look at the more noticeable COMEX futures positions. Este es el mercado al contado. Let's examine the futures market, which is quite similar. Every month, we see how deep of a hole the Fed has created. This is best shown by the steadily increasing end-of-month figures in yesterday's end-of-quarter market event. Despite a huge effort to remove as many spec-long positions as possible by the end of the quarter yesterday, there was an attempt to do just that. In short, the Fed had to buy back gold leases that had lost value at exactly $409 per ounce, which was higher than the price they could manage last month. Since there are still 30 tons to buy back on the market, this will raise the selling price of gold even more. If I'm a seller and I notice this demand increasing, I'll raise the price. The Fed is responsible for the remaining unbalanced short bets against gold. They don't have any physical gold to support these short bets and did not see that the COMEX had to start accepting prices rather than set them. The only solution now is to buy back this borrowed gold at the market price before an inevitable increase in the gold price happens. As we just saw, right now this will cost them more than $400 an ounce compared to last month's BIS repayment. After some healthy skepticism about our claim that the Fed needs to adjust the value of gold, it looks like we are not the only ones thinking this way. Bloomberg first reported it on Monday, and Zera Hedge, along with other major media outlets, has joined the conversation. We won't go into those other publications right now. As we summarized in our last episode, the constant demand for brick skull has pushed the traditional paper market to a difficult turning point that can only be fixed by one of two events. A huge bid with a T+1 margin call means it will be delivered immediately. This can be resolved in one of two ways. It could cause gold prices to soar, as we mentioned last time, potentially increasing thousands of dollars, or it could be resolved more fairly through a more organized revaluation of gold prices by the U.S. Treasury. Now that global physical gold exchanges are active enough to set a real supply price outside the CME-LBMA restrictions, the quiet process of revaluing gold that began after the Bank of International Settlements classified gold as a top-quality liquid asset on January 1st, 2023, has gained enough strength to require a revaluation of U.S. Treasury gold. Ahí está. You can begin to notice it. We have pointed out that every non-dollar priced gold has pushed dollar-priced gold to all-time highs. The gold price in other currencies has been reaching new highs long before the dollar price went up. However, as we've been discussing, the big shift happened when China made the UN gold fully Basel III compliant. This was followed by allowing Western institutions to trade and store gold safely, which reduces the risk of unallocated gold. It's obvious. Keeping that in mind and knowing you need enough funds to proceed, it's important to note that the SGE market holiday starts today. Now looking closer, it shows that SGE has now surpassed Loco London as the main global price setter. The small amount of 3 to 5 tons of basal, 3 compliant London spot gold that is settled at the fixes, is much less than the 15 to 50 tons of SGE gold that is physically taken out every day. Recently, we've seen these volumes increase quickly, reaching record high levels of 53 tons entering warehouses at the end of the day. This gold is going to China, hurting the old cartel. These footprints show that the SGE global bullion trading hubs have become liquid enough to find 2 competing institutional-grade, Basel-free compliant physical fixes. That's 10:15 a.m. and 2:15 p.m. in Beijing time. That allows the diluted local London fixes, which happen twice a day, to be used for one-to-one arbitrage as a standard. Now all the clues are present. Each Asia purchases physical comic sales paper sessions, and we see several examples of this comparing AM fix to PM fix. We have noticed some changes in behavior, but typically, Asia buys and the West sells. Once again, we notice a change in behavior here, but that's just because the short sellers were squeezed more than they could handle. Once more, we notice a new high today, Wednesday, followed by the PM fix being lower. All this does is prepare China for another situation where only Asia can make bids, similar to what we observed after the sell-off. China may be on holiday, but the PBOC is still working. Like I said, the demand for ETFs will keep going. It has only just started. Now let's examine why CME margins, which is the fee to borrow a 100-ounce gold contract from the house, is currently $17,000 for each contract. Let's examine why they haven't increased these margins from $280,000, which is 6.07% of that amount. And why I haven't even noted the latest highs here. I just recorded this yesterday. The contract value was $390,000 and the CME margin was just $17,000, making it only 4.3% of the total value. This brings up the question, why hasn't the CME increased gold borrowing margins? We need to remember that we discussed how speculators buy gold and that there's a desire to push those prices down. You want to take the ad without risk and create short positions against them. Then you increase the margins, and since they are heavily leveraged, they have no choice but to sell. This raises the question, what's different now? The gold first-tier reclassification after Basel III on January 1st, 2023, led to a rally of 970, increasing from 1,830 to 2,800 by November 1, 2024. This caused the CME to raise borrowing margins for GC on that day. This margin went up because many heavily leveraged investors had borrowed gold from the controlling COMEX cartel, which caused a $260 sell-off over 2 weeks. Like I said, why hasn't it gone up since then? The gold price has increased to about $1,300 this week, reaching close to $30 or just over $3,900. This lowers the cost to manage around 390,000 positions, which is 4.3%. To put this into perspective, the unallocated GC contracts, which are gold futures contracts, are currently highly leveraged at 96 ounces of paper for every ounce of gold. The answer is easy. Gold was also excessively bought, and notice that it was also excessively bought in November of 2024. There was still enough open interest from heavily leveraged speculators for the house to aim at covering the one-to-one shorts they had put against these speculators. Now, it's the legacy shorts that are at risk. Despite the pressure to increase margins, the house has decided not to raise them. Because this is so obvious and there are questions, it might happen, but currently, the healthy long stock positions have built up enough cushion that if you increase them now, the longs can handle a margin call easily, because they have solid support beneath their investments. The shorts would be at risk from a small increase in borrowing costs because it would make them have to cover their shorts. Los pantalones cortos están estirados. Silver is entering a significant time of price changes. The COMEX, which used to set the global standards for precious metals, now has to accept prices rather than control them. Even with high volatility and increasing demand, silver futures margins have not changed. This decision aims to safeguard the major naked short positions that are still present in the silver market. However, as global supply decreases and the metal has recently been marked as a critical mineral, Russia, China, and now the US are all stockpiling silver at record levels. At the same time, geopolitical tensions and potential export bans are putting more pressure on the market. The lack of physical silver is starting to reveal the weaknesses of the paper market. Dollar-denominated silver is still priced lower than its record highs in other currencies. This is mainly because China is heavily buying it. As Western institutions return to the market, new demand is taking in every drop in price, driving spot and futures contracts to their highest levels in decades. The latest numbers reveal that more than 370 tons of October silver contracts that were not delivered are now being requested for physical settlement. With the Fed unprepared and lacking physical metal to provide, the chance for a strong increase in value becomes more likely every day. Regresamos a la entrevista. For the same reasons, the margins for silver futures have not been increased to safeguard the significant naked short positions in silver. Now that COMEX has become a price taker, the only way to buy this silver again is to purchase it at market price. But hey, Houston, there's an issue. Isn't that a phrase? Houston, tenemos un problema. Silver has recently been labeled as a critical mineral. Now we are facing serious increases in geopolitical tensions and tariffs. There is a high demand for it in the military of Russia and China. Ahora tiene demanda en Estados Unidos. Basically, that's why we are seeing record prices in every global currency exchange, which is leading the US to gather and soon ban exports of US silver. Hay un solo resultado al reducir la oferta. The offer to sell silver for immediate delivery is just going to increase. Now, let's examine the silver future structure for the same reasons. They have not increased margin calls, and you consider it. Check this out. It's about the protection against very large naked official short bets on silver, and COMEX is now in a position where it has to accept prices. The only solution is to purchase this silver back at market. Like I mentioned, this is the issue. As we just saw, silver has recently been labeled as a critical mineral. In addition to the buildup with Russia, China, and the US, it seems very likely that this export ban will happen soon. Como digo, solo hay un resultado al aumentar la oferta. The offer to sell silver for immediate delivery must increase. The contract value was $165,000, and during the same time, they increased the margins on silver to $16,000. Once more, we witnessed a bit of a conflict there. Eso fue el 9.7% de 165,000. It's still 16,000, and we have actually gone up now. Basically, even though it's a bit higher now, there's still 6.7% of the contract value, which is much less. Now, shorter term, a silver price rose above the short stops marked at 44.275. Si recuerdas, lo marcamos. I've added a color to that circle, but this is where the circle is located, and this is the circle at 53. But basically, it started last Thursday. Then we saw UBS finally updating their silver spot price to between 44 and 47 per ounce, saying it would align with their new gold forecast of 3,900 made a few weeks ago. They also confirmed that they plan to stay invested for a long time and see any declines as chances to buy. Interestingly, although they mentioned all the usual factors like geopolitical support for industries, fiscal deficits, and reasons for moving away from the dollar, they completely overlooked the important reclassification of critical minerals and the global stockpiling agreements driven by the G7. Also, the G7 started to consider pricing standards to counter China's dominance. In summary, this means that the price of silver in dollars is much lower compared to its highest prices in other currencies, particularly highlighted by recent increases in XAGCNY, which is silver priced against the Chinese yuan. It is being influenced by Chinese physical stock. You can see that this is the source of the leadership. Silver price issues are being addressed with CME LBMAs, diluted dollar price for silver targeted for delivery. Now, the long stop rinsing in silver is good because it removes easy layers of salignition, like people who have borrowed silver from the house. They borrowed just enough to create some salination, but it's very minimal because there's not much of it. Everyone knows about the Fed's mistakes and is now looking to take advantage of any price drops. After recent meetings with our Chinese liquidity providers, they report new demand from Western institutions for gold, and, notably, a very large demand for silver after the session ended. We observed the pit, we looked at a pit up close, and we witnessed a bid being pulled during a sell-off in low liquidity conditions. Y así hubo una caída por debajo de 46. We knew these dips wouldn't last long, and that was correct. The spot silver price went down. I call it a dip because there was a strong buying interest that pulled the price below 46 at the end of the month, and the quarter yesterday. Now, remember that the spot price of 46 is about 46.17 in futures. Futures trading is about 17 cents higher. However, that drop caused a lot of people to start buying. It was quickly purchased, grabbed by Asian buyers overnight, leading to another increase. This was once again sold before the London Open, and then bought again by Asian buyers. What happened overnight, specifically by Wednesday morning, was that it reached another high from 2011, which is actually the highest level since the all-time high. It was really 48 and some in the spot market, but 49,820 in futures. Adding to the situation, silver, specifically the silver in CNH, Chinese silver, is in high demand. This demand has pushed it and every other type of silver to record high values against the euro and other currencies. Since prices are being found outside the CMELBMA ring, it's clear that the low-price silver in dollars will surpass all-time highs. Many investors are now buying cheap silver priced in dollars, which is driving up demand. This came after a large amount of 370 tons of non-delivery October contracts were requested for physical delivery. There are still 82 tons of non-delivery October silver that need to be moved out. And why did we expect this fight at 44.275, the last line of defense? Liquidity providers noted that the physical supply is very limited, so any resistance will not last long, because short covering will be revealed, and that's exactly what is happening right now. There is enough short covering fuel in the hedging supply to push the price up to the next staging point of $53. In summary, analyzing gold helps us understand where the support level in the paper gold market is. This follows 20 straight fixes above 3,610, straight fixes above 2,700. Based on today's 4 consecutive fixes above 3,800, this positive action is moving the physical support levels up to another higher point in the rally. Each of these levels had physical support. The spot price of silver dropped below $46. This happened at the end of the month and the quarter, and we are recording this on Wednesday, right after that month end. Also remember that silver is part of the OCC bets, which are related to the Feds. Right now, the Fed is the only one that has a short position in silver. ¿Y adivina qué? They don't have any money to repay this. The evidence shows a clear change. Silver is not only an industrial metal or a way to protect investments anymore. It's becoming an important resource in a world where supply is getting limited and countries are competing for power. With COMEX positions stretched and the Fed's paper shorts more vulnerable, physical silver is proving itself as a true form of money. As countries build up their reserves and export limits are expected, a revaluation is becoming a reality rather than just a theory. It's a process that is already happening quietly right now. This change is not just about excitement or guesses, it's about real fundamental progress. The market is showing who has true value and who just has empty promises. The organizations that used to keep silver prices low now have to deal with increasing prices. This is creating a situation that could lead to a major change in how metals are viewed in global finance. Please share your opinions on their analysis in the comments below. If you find this video helpful, please support us and turn on notifications to keep updated on our newest videos. Nos vemos en el próximo video. Gracias por ver.